In his 1996 letter to Berkshire Hathaway investors, Warren Buffett, renowned for his investment prowess, offered essential advice for setting up an investment portfolio. Buffett emphasizes that while intelligent investing isn't necessarily complex, it's certainly not effortless. The key, he suggests, is to invest within your circle of competence, meaning you should focus on companies and industries you understand well. It's not about having expertise in every field, but about knowing the limits of your knowledge. Buffett underlines that a successful investor doesn't need to grasp intricate financial theories or concepts. He advises against getting bogged down in understanding beta, efficient market hypothesis, modern portfolio theory, options pricing, or emerging markets. In fact, he suggests that being unfamiliar with these might even be beneficial. This view diverges from the common curriculum in most business schools, which often heavily focuses on such topics. For updates on savvy investing tips, make sure to subscribe to our channel. Instead, Buffett believes that investment education should concentrate on two fundamental aspects: how to value a business and how to think about market prices. The primary goal for an investor, according to Buffett, is to purchase a stake in a business that is easy to understand, available at a fair price, and likely to increase its earnings significantly in the future. When such a business is identified, Buffett advises buying a substantial amount of stock and sticking to your investment principles, resisting the urge to deviate. This disciplined approach has been the cornerstone of the remarkable success experienced by Berkshire Hathaway shareholders. Over the years, this strategy has led to significant growth in profits and a corresponding rise in the company's stock price, as Berkshire continues to enhance its earnings through existing business ventures. Investing in businesses with enduring competitive edges has been a key strategy of Warren Buffett. His investment portfolio has achieved a remarkable annual compounded growth rate of 19.8% from 1965 to 2023, significantly outperforming the S&P 500's 9% during the same time frame. Moreover, it has registered a staggering overall growth of approximately 3.7 million%, dwarfing the S&P 500's growth of 24.708% in the corresponding period. Now, turning our focus to the economic landscape of 2023 and beyond, characterized by high inflation leading to increased interest rates by the Federal Reserve and, consequently, a slowdown in growth. It's easy to feel like a genius during a bull market, as was evident in 2020 and 2021. But such rallies are not permanent. However, Warren Buffett has outlined certain strategies to navigate through such challenging economic conditions successfully. During times of market slowdown, opportunities arise to invest in high-quality companies. This aligns with the strategy of entering the market when prices are low. Historical patterns of the Dow Jones Industrial Average suggest that periods of significant downturns are often followed by robust recoveries, making such periods ideal for stock purchases. What then is Warren Buffett's advice for investing during inflationary times? The key lies in perceiving stock as a part of a business. This involves a thorough analysis of businesses before investing in their stocks, a fundamental aspect of Buffett's investment philosophy. In times of inflation, the focus should be on companies that can thrive in such an environment. These companies typically are not heavily reliant on capital and possess the ability to adjust pricing. How do we identify these companies? Warren Buffett elaborated on the necessary criteria for such businesses in his 1981 letter to Berkshire Hathaway shareholders. A time when the economic climate bore similarities to current conditions. A crucial characteristic of these companies is their capacity to raise prices effortlessly even when the demand for their products remains stable. In a context of underutilized capacity and inflationary pressures, companies like Apple and Coca-Cola stand out for their remarkable pricing power. They can raise prices without significant loss in market share or sales volume. This is primarily because of the strong consumer loyalty towards these brands. For instance, Apple's iPhone has a fan base that remains steadfast even with price hikes. Similar to Coca-Cola's products, these companies exhibit two critical attributes as per Warren Buffett's analysis. 1. Ability To raise prices without losing customers, businesses like Apple and Coca-Cola can increase their prices during inflationary times while retaining their customer base. This resilience is due to the strong brand loyalty they command. In such scenarios, these companies are less impacted by inflation compared to others. 2. Capacity. To handle large dollar volume increases with minimal capital investment, companies that can handle significant increases in business, often driven more by inflation than actual growth, with minimal additional investment, are more efficient and profitable. Tech giants, for example, can generate new revenue streams by introducing new features or services at a fraction of the cost it would take a traditional manufacturer like Ford to develop and produce a new vehicle model. Buffett emphasized that even managers with average abilities can achieve outstanding results by focusing on acquiring businesses that meet these criteria. His insights from the 1981 letter highlight the importance of concentrating on individual company performance rather than the broader market trends, especially in inflationary times. Moreover, Buffett advocates for investing in oneself. Enhancing personal skills and talents is seen as the best defense against inflation, as it potentially increases one's earning power and purchasing capacity, thus mitigating the personal impact of inflation. In essence, the ideal investments during inflation are those in businesses that require a one-time capital investment without the need for continuous reinvestment. Such investments are efficient and reduce the burden of escalating costs over time. Amid inflationary times, gold is often lauded as an effective hedge, a strategy embraced by many to shield their wealth from inflation's impact. However, Warren Buffett holds a contrary view on this matter. He points out that gold, fundamentally, is a non-productive asset. Investing in gold means you're banking on the hope that someone else will be willing to pay more for it in the future than what you have paid. Essentially, when you invest in an asset that doesn't generate any output or profit, your returns are entirely dependent on someone else valuing it more highly later on. Regarding investing during periods of rising interest rates, Buffett highlights the overarching influence of interest rates on investment valuations. He asserts that low interest rates enhance the value of future earnings streams from investments. Conversely, high interest rates tend to diminish the value of these investments. In Buffett's view, interest rates are a key factor in determining valuations over time. The benchmark for comparison, he notes, is often the yield on government bonds, and you can choose the maturity that aligns with your strategy. It's crucial to recognize that interest rates represent the cost of borrowing money. In an environment of low interest rates, borrowing becomes more affordable for businesses, potentially spurring economic growth and incentivizing investments in the stock market. On the other hand, when interest rates are high, the increased cost of borrowing can exert a dampening effect on economic activity. In a climate of heightened interest rates, businesses often find it more challenging to invest in growth initiatives. Such economic conditions can lead to a decreased inclination among investors to allocate their resources to stocks, potentially diminishing their market value. Furthermore, as interest rates rise, bonds and other fixed-income investments become more appealing due to their elevated returns. This shift can result in investors reallocating their funds from equities to these alternatives, contributing to a decline in stock prices. Despite the allure of bonds in high-interest scenarios, Warren Buffett advocates for a continued preference for stocks over bonds for long-term investment. He has long maintained that equities are a superior choice, especially when compared to the returns offered by bonds in the early 2010s. Buffett highlights the disparity by noting that a bond yielding 2% is effectively priced at 50 times its earnings, with no prospect for earnings growth. Moreover, he points out the irony in the government's intention to erode the value of these returns through inflation. While acknowledging that certain circumstances might necessitate holding bonds for legal or other specific reasons, Buffett considers choosing bonds over equities voluntarily, particularly over the last decade, as an unreasonable decision. Ultimately, in situations of high interest rates, Buffett underscores the greater potential for growth and returns presented by equities. In his view, despite the immediate appeal of bonds and other fixed income assets, stocks offer a more favorable long-term investment prospect. For updates on savvy investing tips, make sure to subscribe to our channel.